Okay, welcome everybody. I'm Giuseppe Basile and I will be your host today. This is the weekly show, FibStalker's FS Street weekly show. Today is November the 23rd, 2016. It's Wednesday and we have this appointment and this show. We hold it every week. So if you are interested and keen on the content that you see here, I'm happy to see you at the show live. I understand that doesn't work for everybody because of the time. It's 7 p.m. EST time in Toronto. But if you're here and if you ask questions, I'll be very happy to answer your questions. So thanks for joining. As you know, risk management is everything in trading. In fact, I believe it's trader's job number one. The information, including the commentary and trade ideas, as well as setup that you see here, should not be relied upon as a substitute for your extensive independent research, which should be done anyway before trading. Okay. So today I'm going to talk about I'm going to split this show in two parts as usual. The first part is going to be educational, and I'm not going to talk about myself. I'll only remind you that I have my FibStalker Methods coaching program. I have session 5 starting this Saturday. So if you want to join, there's still time for that. Just drop me an email at fibstalker@gmail.com. I also started recently a trading signal service, and very happy the Winning with Algos community is growing and we're having great results, and I'll touch a little bit on that in this presentation as well. Now, you can reach me at fibstalkertrading.com as well as winningwithalgos.com. I also have a legacy blog that I'm slowly importing into fibstalkertrading.com, and you can reach me anytime at fibstalker@gmail.com. I answer all your questions. All right, so the first part of this webinar, it's related to profit taking. And I want to present two strategies for profit taking, and that's the educational piece for this week. Now, I'm going to extract those two strategies from a document that I actually wrote and distribute to the subscribers to my signal service. It's an how-to guide, and in the document I speak about how you take advantage of the service and how the signals are presented and so on. Last week I presented 3 strategies to enter, and this week I want to focus on profit taking and moving stops. I don't know if you can see this. I'll try to make this a little bit bigger here. Allow you to read here. We're not going to read all this. I'm just going to show you what are the two main ideas here. As you know, as you might know, I'm a fan of using risk-free levels and risk-free trading. Now, I explained risk-free trading last week, but I'll be I'll do a very quick recap about what risk-free trading is and how we calculate the risk-free level. And the risk-free level is involved in the first strategy. As I mentioned, we're going to review 2 strategies here. The first one is the risk-free level strategy, is the strategy number 1, and the second one is basically taking profits, never taking partial profits out, at least until we get to the first target. Now, my trades typically can have 1 or 2 targets, so and that really depends on a number of factors, including how the market is moving, the current market conditions, and occasionally the second target will be considered when market conditions warrant extended moves and the probability for the market to move to the second target, it's actually higher. So when we look at these two strategies, and by the way, if you like the content, I'd be very happy if you would actually tweet the content on your tweet account. Now, I have a free course here, winningwithalgos.com/start. If you're interested, go and have a look at it. Now, as I mentioned before, to introduce the first strategy, I need to talk a little bit about risk-free trades. When I speak about risk-free, doesn't mean that we can remove risk from trading. Okay, that's impossible. However, although trading risk cannot be eliminated, and we have to consider trading as a business, risk can be removed if price behave in a certain way. Okay, so if price moves in the direction of the trade early enough during the trade lifetime, and here I want to show an idea what that risk-free trade is. Now, in this simple example here, I'm showing two lines. They represent very schematically, very simply, the entry level, or the start of the entry area, I should say, and the stop level. And it's also, for me, the stop level in the method I use is also the level where I'm not going to look at the opportunity any longer. So these areas as an importance for me, but what I want to introduce now is the concept of risk-free trading. Let's say that we enter right at the entry level, okay, right at the level, and we place a stop, an hard stop at our stop level here. When we do that, we are carrying a risk, a pip risk, a dollar risk, can also be expressed in dollars, of course, which is related to the percentage of our capital we risk. We can risk 1% or more, depending on, again, on your money management technique, which we're not going to discuss here. Now, if we carry this risk, and again, they can be expressed in dollars or in pip or ticks, there is a specific level, unique level, that is identified in our trade, and it's the level where our trade is going to show gains that match the initial risk. Okay. So this level is unique, and it's calculated very simply. Setting aside any spread and any other consideration, this distance D in pip, if we add it to our entry level E, then we get a risk-free level, which is basically the distance between E and S above E. Okay, now this level here is unique, and I call it the risk-free level. Why risk-free? Because if we behave in a certain way when price gets into this level, so it goes in our advantage and enters and gets into this level, then we can generate what I call a risk-free trade, or conditions to be risk-free. How do we become risk-free? Well, if this market goes into the area where we get involved and then moves quickly into this level, and we remove 50% of the position when we are here, right? We take half unit of risk, equivalent of half unit of risk in gains, we take it out from the market. Now, when that happens, this trade becomes risk-free, because whatever the market does next, right, we don't really, it's not really important. And there are two outcomes that can happen. Either the market gets to our first target, or the market is going to stop us out, right? Maybe coming back here and then stops us out. So if the market actually stops us out, and this is then, I'm going to elaborate on strategy 1 here. If the market stops us out, and so the market does something like this, so it goes into that first target and then it comes back and stops us out. We took 50% out of the position here, so 1/2 of the initial risk in dollars or in pip was taken out of the market. If the market comes back into the stop loss, we then lose 50% of our initial position, which was, you know, 1/2 of risk. In this case, as you can see, we take something out of the market, we lose that same amount of pip dollar when and if the market hits the stop, and so we end up basically with nothing. Of course, we will have some costs. Those are the cost of doing business. Those are the transaction costs, spread cost, liquidity, and so on. So, but generally, the cost of this trade, if you're stopped out, is going to be very, very small, near to break even. Okay, why is this strategy important of profit taking? And what is the actual strategy? Supposing that we have a risk-free level here, as is shown here, and we have a first target somewhere higher, let's say this is going to be our first target, then this strategy allows us, this profit-taking strategy, it's very, very specific. We take 50% of the position out of the market at the risk-free level, and then we basically take the other 50% out, so closing the position if the market gets into the first target, or we actually take it out if the market actually gets into the stop. So as we mentioned, if the market does this, we basically close at break even. But if the market does this, then we close at we close with a gain, and our gain can be calculated as the initial reward to risk that we had plus 1 divided by 2. And this is going to be our new, I call it adjusted reward to risk that we have if the market behaves like here in case 2. So there are 2 cases. So why this the profit-taking strategy is actually important? Because by taking out of the half of the position out when the market gets to the risk-free level, we can let this market move as it wants. So if you have psychological problems or related to trading, of course, or discipline issues, then although this strategy returns a small reward to risk compared to what you could get out of the market if you were not choosing this strategy, this strategy actually helps you developing the right beliefs and the right behavior in relation to the market. In fact, the right behavior in relation to the market is to never move the stop higher, or certainly not during the early stages of a trade. A lot of people like to do this whenever they get a fill. They actually move the stop higher. So what they do, they had initially the stop here, and they move it at entry. So they now move the stop here. However, when you do that, you don't leave the market the possibility to keep moving and do whatever the market has to do, which includes getting back into the entry area. In fact, you will see that a lot when a valid 50% level in the FibStalker methods or any other area that you use to enter your markets is actually tested. Very often you will see a market that moves laterally and can retest the level a number of times. Okay, and this concept of raising the raising the stop. It's a little bit, I believe it's son of strategies that leverage volatility or breakout kind of strategies, whereas we always we already see price moving in the direction of the trade. However, we also have to remember that anytime we have such a price behavior that that we have position that leverage somehow breakouts, you know, those positions are also very close to their first target as well. So we are interested in taking advantage of price around levels where price reverses, rather than taking advantage of price when there is a breakout from a previous consolidation. Why? Because when that happens, price is very close to this first target. So generally that means that the reward to risk are lower, but most importantly, the risk in the trade is higher. See, very often what happens is that when such a breakout takes place, the market has already set up around these areas of participation of algorithms. And not only, it has also touched the risk-free level that allows us to become risk-free. Okay, so the importance of using the risk-free level is that it helps you build the right behavior and also beliefs about trading. And central and very important belief is that you let price move and you never raise or change or lower, in case of shorts, your stops. Okay, so this is one strategy you can use. So the main disadvantage of this strategy is that basically you have lower reward to risk, because you have an adjusted reward to risk, and the formula, it's very simple, equals the initial reward to risk you would have in this trade plus 1 divided by 2. So the fact that you're dividing your initial reward to risk, that you want to be probably bigger than 3 or bigger or equal than 3, then you're obviously reducing your adjusted reward to risk with this strategy. However, you're building consistency and you're building the right beliefs when you use these strategies. The detractor of these strategies usually tell me, well, you know, you're taking the highest risk at the very beginning. You're risking here 1 unit of risk when we enter. And then when the market is finally moving in your direction, you then remove half of your position. And I say yes, and I do that gladly if that helps me. I understand that. And I do that gladly if it helps me to reduce the risk in my trade. And most importantly, it helps me to stay with the trade and never ever change the stop. This is so important. In fact, if you study different methods of entering into the market, you will recognize and you will see yourself that moving the stop always reduces the reliability of the trade and the possibility for the market to get into first target. All right, so this was strategy 1. When we go back to the document here, there is a simpler, another strategy, which is just to not consider the risk-free level, not even calculate it, and just keeping the position as is, of course, without changing a stop, without hiring or lowering the stop for shorts, and just take the full position out at the first or second target occasionally, if market conditions warrant a larger move in the direction of the trade. Okay, so for now, I'll just I'll just make reference to the first target because I want to show a concept here. So then strategy 2 really it's something even simpler here. And we have strategy 2. We have the same situation here, whereas, and again, this is I'm now talking about strategy 2 here, and the concept here is slightly different. First of all, in strategy 2, we do not consider the risk-free level. We behave like that level was not there. We don't know about this level. We don't choose it. And what we do basically is just whenever there is an entry or an entry signal, we enter into the trade, and what we do, we just let the market move and do whatever it has to do. Even if it comes very, very close to the stop, we will just keep the full risk without doing anything. Okay, and in this case, then what we can anticipate, as usual, there are two outcomes, and the first outcome, of course, is that we are stopped out, and that's the first outcome. We enter the market, might even go in our direction, but eventually, what happens is that it stops us out, or the market can actually, continue higher and eventually get into that first target. Okay, and this is outcome 2. So there are always 2 outcomes in the market. In order to not interfere with your position and what the market is doing and what price is doing, the best thing to do is to be able to accept risk. Okay, if you risk 1 unit of risk, which could be, for example, let's say it's 1% in your case, well, you have to fully accept the fact that you can lose that 1%. Now, 1% is not a big deal, but I know a lot of traders, especially starting traders, who believe that they can conquer the market with discretionary decisions, and they risk way more than 1%. In fact, there are people who risk 10 to 20% without even realizing it. And how do they do that? Well, basically, they take decisions based on a number of discretionary conditions or decisions, and they really never consider the fact that the market could actually go well against them. So they never entertain the fact that the market can move 20% against them. And the problem is that when and if that happens, then they're in big trouble because they never accepted the possibility that the market could do something like that. And so I often talk about risk acceptance, because whenever you put on a trade that has and you know where your stop is, and you'll be surprised that I remember in 2014 I was in a meeting with the North American responsible for sales at OANDA here in Toronto. That was 2014, and this person was actually talking about aggregated figures they had on traders' behavior. Of course, they can only provide aggregated figures, and 22% of traders at that point with OANDA, they didn't have a stop, and obviously that resulted in getting margin calls at all the times. So there is at least 1 out of 5 players in average in the markets who do not even know the concept of stop, and probably they know very little about risk management. So That to say that you shouldn't be surprised to meet people who believe they can play the market and don't even know how much they are risking. And in fact, very often I spoke to starting traders who had position and also had discrete success, but to the question, how much are you risking? What's your risk? They could not answer that question. Okay. Now, if you want to use strategy 2, obviously you know how much you're risking, and for some of you this is obviously basic, and if you enter around this area, you're risking 1 unit of risk, whatever it means for you in terms of dollars, or pip risk or tick risk for your market. For example, you could be trading futures on Forex or SP 500 E-mini, or futures on gold and silver. You could be trading stocks as well, because these methods work for stocks. The point I want to make here is that whatever you risk, you have to accept that risk. And in a risk-free trade, you exit half of the position when you get into that level that equal your risk. In the strategy 2, you just keep it till you get to the first target, which means that you have to accept any outcome of the market. And one of the outcomes is always that you lose your unit of risk. The other one is that you realize your initial reward to risk ratio. And talking about reward to risk ratio, in this strategy, strategy 2, which is the strategy where you don't take profits at the risk-free level, one advantage is that typically reward to risks are higher, and you realize the full potential of this trade. If the initial reward to risk is 3 or 4, that's what you make. You risk, let's say, 1%, and you can make 3 to 4% on this trade. Okay, so that's the advantage. The disadvantage is that if your entry area is smart enough that very often allows you to move price into that risk-free level very often, then by actually not using the risk-free level profit-taking strategy, then you are putting yourself at a higher risk, and the higher risk is that you lose 1 unit of risk. Now, this is part of doing trading. Is the cost part of, let's say, this is the cost of trading. It's the cost of doing business, and you have obviously to accept this. You also have to make sure, though, that you take your positions in areas that are proven to be to work in terms of quickly generating gains or quickly putting the position in your favor. If you do that, you still have you can still have the option of deciding to use the risk-free level, because that reduces the reward to risk, but basically makes very often your trades risk-free. And if you have problems sleeping, if you feel the pressure of having money on the market, there are 2 things that you have to consider. First of all, whether you could benefit from using a risk-free approach. Second is, and this is the most important question, is, are you accepting your risk? Because see, if you're not accepting your risk of losing 1 unit of risk, whatever that is, it means that that unit of risk is too high, and maybe you have to work a little bit to reduce that. Okay, so there are always different ways you can work on your psychological response to trading, as well as on your discipline. And I gave you a few ideas in this educational section here. So if you have any questions, you can I can answer them now, or you can actually send me an email, fibstalker@gmail.com. Now, as you know, in my models, I use smart money, which is which actually models modern algorithms. I should say a class of modern algorithms that is derived from program trading of the 80s. And I also look at how dump money behaves. And what I have synthesized and identified with my studies is that smart money initiates and leads moves in the market, while dump money obstacles price and follows up. Dump money is reactionary, while smart money is actually proactive. Now, I truly believe that in order to win in the trading game, we need to start the smart money because of the nature of how they can actually affect price and the fact that they initiate and lead price development. Okay, now, so you can learn to recognize these two groups in a number of ways if you like, and one is to join my FibStalker trading signal service. You can do that at winningwithalgos.com signals. Have a look at that. You can also learn more about smart money, which leads, initiates, and leads moves. And I have a free trading course of 6 hours at winningwithalgos.com/start. And if you are really serious and you want to learn how both of them affect price, then consider joining my FibStalker Methods coaching program. All right. So, and this concludes this section of the webinar, and this was the educational section on the two strategies to enter to take profits in modern market. Thanks for watching. All right, now in the next section, I'm going to review the 4 markets. I selected for you the euro dollar, the New Zealand dollar US dollar, the Australian dollar US dollar, and US dollar Japanese yen. So I'm going to start from the euro here. I'm going to bring in the charts and we're going to review what happened and most importantly, what could happen, because I'm much more interested in what will happen. And when we'll move to the euro US dollar, by the way, this market was also an idea for this week, and it traded nicely. And in fact, we are carrying a short also in the trading room. So, and that's something that we traded again in the room. If you like this presentation, again, you can actually share it. I want to share with you the trade short that we took this week. We also took a trade last week, which was successfully closed the next day. So this week we kept trading this market on the short side, and we had participation coming from a level that had traded last week. And basically we actually looked at a continuation this week, and that continuation brought price into an area of participation that we saw participating. We saw participating this actually yesterday, and yesterday the trade triggered, and as you can see, we have a partial profit here, which is 105.36, which has been touched today, and that's the reason why then we saw that we saw some profit taking here, which you can see here from the bar that touched the 105.36, and then we saw some profit taking on the smaller time frame. What is important and interesting in this market is that this market is pointing to a much lower target, and that target is actually identified by the 50% retrace that has traded the day of the US electoral vote here, the night of the US vote, and that trade has actually brought price into the 106.74, which is the first target, and it's pushing now price even lower to the 104 level. I'm going to show you here, and that's our final target for this trade. That's the 103.83. I'm going to take profits at the 104, and that's where we want to bring this trade to. Okay, so as you can see, that's new lows, and that's perfectly possible. You also have to know that there'll be important planned geopolitical events in Europe, particularly the vote in Italy, which is my country actually, the vote on the constitutional changes. Changes to the constitutions, and at the moment the party was actually winning is the no, so no constitutional change. Now, if that wins, we could have actual repercussions in Europe, and this could be the fundamental reason. Along with a very strong US dollar that might keep pushing this price lower. But whatever the reasons, we always know that nodes tend to complete existing setups, and this setup as a second target just above the 104 level. So this is my review for this market. This market is trading an extension that was identified and it respected 61.8% level, almost to the pip there, and it's pushing this price lower into two levels. The next level is going to be the second target here, which is 104.82. So we should see probably this week very quickly this market continuing lower. If this market retraces from here, we're going to capture. We'll keep capturing it at the next measure move here. Okay, and this could be as high as 106.18, and will be again an opportunity to short this market from 106.18 down into the 104. So this is my, if the market gets there, the market could just continue sliding, and that's why it's important whenever you have the opportunity to take positions in this market, which at the moment are moving strongly into targets. All right, so this is my view here on the euro dollar, and thanks for watching. Okay, next I want to review the New Zealand dollar US dollar. This too was an opportunity this week that was identified in my service winningwithalgos.com. If you want to get information, just go to winningwithalgos.com/signals and you can get information about the service. So let's go and review the New Zealand dollar here. And when we go back to the charts, we look at this short opportunity here. We played that as well, and it's working. It's working very, very well. And the this market actually, let me. So when you look at this market on a larger time frame, we have a sequence of measure moves, so algos, which actually have traded this market on the upside for some time, but then that move higher at some point has failed. So we saw the market participating around this area here back in June here. It was participation at the 0776 area, which broke price into first target. As you can see here, the market did not make it into that second target. and it actually retraced into the next measure move here, which we saw playing here at the beginning of July, end of June. So this market in the same, at the beginning of June gave an opportunity here, beginning of July, another opportunity. This area was retested and eventually price went to that first target, okay? And the algos gave up on this market, and there are some reasons why that happened as well. They gave up when we saw this break here. The smaller time frame pushed this price higher again into an area of potential resistance, and the slide down started. So what is this going to bring price? Well, we have a couple of levels, the most relevant being the 68.46, but I'm going to go for 68.60 here, which is my target, just on top of this area of potential support. Okay, so this is the case that we built. Again, this is the case that we built in the in my signal service here, winningwithalgos.com/signals, and we traded this. All my students as well as the subscribers traded this opportunity, and the way we identify the opportunity and the trading plan, I'll show it to you here and on the daily time frame. We actually have traded, we have actually considered a couple of levels. There was a level that came into play here, as you can see on the day, on the 17th of November, and it brought price to that first target, and then we actually used the same anchor to the new low, and this allowed us to capture the next retrace, as you can see. And I do this consistently by applying rules of the FibStalker method. So if you're interested, that's something you want to look at. Now, this gives us an indication of what is going to happen next year. So as I mentioned before, here's the weekly time frame, tells us that we're going to go to 68.80 very probably, because there is no participation from smart money before we get into that level. And so that's the most probable outcome. And obviously, this price behavior is helped by the strength in the dollar at the moment. But algos told us basically on this day, at the end of September. At the end of September, we knew that algos would not get involved on the weekly time frame until we got into this 68.60. So as you can see, this kind of analysis can be very powerful in terms of what can happen next. It doesn't mean that the market just slides into that level. It means that this is the only level where participation can come, which also can come from the weekly participants, which also suggests that any move that is not supported by a larger time frame eventually is doomed to fail. And that's exactly what happened here. So this happens all the time. If you want to learn more about this, drop me an email and consider joining the FibStalker Methods coaching program. I'm starting a fifth session of it on actually this Saturday. So if you're interested, just let me know. Now, the beauty of this is that there is, for this market, support from smart money, which actually took a position here. And today we saw the level was retested to the pip. The high was 70.78. The high was 70.79. So it's not a case that this happens. And the market actually got into that first target. Look at the beauty of it. The second target lines up right with that area of potential support. So obviously, the daily will do whatever it takes to bring this price into this level, and then that will just get lost, because at this level, there'll be weeklies ready to test the price. We don't know whether weekly is going to come into the market at this level, but that's the most probable level that they will come, and at least will take profit. So it was a beautiful trade here, traded with a very small pip risk, and it has the potential to move and will move all the way into 68.10. All right, so congrats to all of you who actually have taken this trade. And this concludes the review for the New Zealand dollar, US dollar. Next, I want to review another trade that we have traded in the in our trading room as well today. And again, if you like these reviews and you want to share them, feel free to do that. You could use something like this on your Twitter account. Now let's look at the Australian dollar, US dollar. The theme and the play is very similar to that of the euro dollar and the New Zealand dollar as well. And we basically played, as you can see here, this market in the same way. This market came very quick, very close to the stop level here, and only adding spread saved me in a way. The reality is that this market went to trade the higher level, and this market went to trade the extension short to the pip from 75.78 to the recent lows that we saw on November the 31st. So the reason why this market has bounced at this level is also because it traded actually the 50% retrace from the lows at the beginning of 2016 to the highs in April has forced somehow this market to take profits. Okay, so this market was relatively stronger than other markets we saw trading similar setups. The beauty of it is that the stronger the reaction, the stronger is going to be the move lower as well. In fact, when we actually explode this market, we see that this market has, below current prices, it has a first target in the 72.47 area, and a second target which is well below that area of participation from long, which was already broken in May this year, and that level is a 71.54. So talking about then almost 300, sorry, 71.45. So talking about exactly what about 300 pips of move here, with a risk that could actually be as low as 10 pips actually when timing on the 1 minute, 15 minutes. So these are the kind of potentials that we can get from these trades when we fully leverage the presence of algorithms in the market. And you know, euro dollar, New Zealand dollar, Australian dollar shorts were recommendations for this week, and trading plans were given before the fact. And so we congrats again if you took this trade, and we are bringing this trade to targets. And this concludes the review of the Australian dollar, US dollar. Okay, the last section of this today's show here would be dedicated to the US dollar Japanese yen. Again, if you like this review and you want to tweet it, feel free to do that. Now, the US dollar Japanese yen has been extremely strong, piggybacking on strength in the dollar index as well. There are some people who believe that the dollar index has started a new leg higher, and a very strong leg higher, as you can see here. And this market is now at a 50% resistance level, and that's the reason why this market has stopped right there for the moment. Now, when we study the long-term market here, you will remember that we were able to identify this 170 area where the market has bounced a number of times well before it happened. In fact, we were able to identify this in May last year, believe it or not. It's simply a 50% retrace. Once the market has right at this point confirmed the end of the longs, there are some people believing that this market could get to 131 in the community. I mentioned that the world sequence of measure move higher was completed, and so this market had only one direction to go. In fact, for those of you who were following us here on FS Street during the Tokyo open room show, we captured this 121 here. We brought it first target, but the market continued lower. And if you subscribe to the FX Street Premium videos, you will also learn that I've made the calls here and here, and these were no more than just extension shorts, as you can see here. The first target, and then again another trade here to second target to the pip. So the importance of the effects of algorithms, these classes of algorithms in price is very, very clear here. Now, where are we at the moment in this market? We had participation from weeklies who are willing to bring this price, believe it or not, to 137.71. And that's only the first target of this measure move that started in this market back in mid-July here, if you wish, beginning of July, mid-July. There were a number of tests between June, end of June, and beginning of October here. And if we actually discount or remove this, the tail that we had here the day of the US electoral vote, we have a very clear pattern here, and we had this market very, very strongly moving into that area, and we hit the first and second target. So this market is very strong. It's not going to immediately to retrace right away, or it's not going to retrace a lot right away. However, we could see some weakness next week. Now, that said, when this market starts moving, it can move for weeks and months without breathing, actually. And we have a proof when we go back even just a couple of years back here. You can see that this market can start moving, and when it moves, it really moves. But nothing lasts forever, and this market is also very, very technical. So when it will correct, it will correct to very technical levels. And if you follow my analysis, I've been actually calling longs here and the correct sequence of measure moves for years, basically. In August the 1st, you'll find an article on FS Street where I mentioned the two targets that eventually this market traded. And there was August 2015, and there was a 15% retrace here, and that market actually moved then eventually into the first and second target and continued higher. So what can happen next here is we need to look at the weekly time frame, and I'm going to look at potential retracement from two levels. So one level is going to be this one, So if we get a retracing to 109, 110, 110 here next week, I'm going to consider this as a new long for this market, which is going to challenge the position that an area where weekly shorts could come in here. And that's starting exactly at current price, 112.35, 112.45. We are around that area where weekly could actually participate. If we get a reaction lower here, no, I wouldn't be I wouldn't be worried because any reaction lower is going to be very probably an opportunity to keep buying this market. Okay, so 109, 110 next week is going to be an opportunity to buy this market. Now, also remember that after today, tomorrow and Friday, it's likely going to be very slow days because of the Thanksgiving holiday and Black Friday. So I don't expect a lot from this market as well. All right, so the review for the US dollar Japanese yen. Now, if you want to get in contact with me, FibStalkerTrading.com, I have a number of premium products there, and definitely have a look at the Winning with Algos community with my signal service. And you also want to have a look at the FibStalker Methods coaching program, which is my high performance method. And I'm at the 5th session at the moment. I have created a number of successful traders who have reported very good results with the method. So if you are interested, consider joining. I have, for November 2016, I have the coaching program starting this Saturday. This is it. These are my contact number. Thanks a lot for watching this webinar. And should you have any questions, I never shy away. Come to my email here. Send me an email. I'd be very happy to answer any questions you might have. Thank you very much and have a great one. Bye-bye now.